Closing Bell. I'm Maria Bartiromo. We're here at the New York Stock Exchange. The week seems to be ending on a down note, but we are all watching the White House right now, Bill.
That's right, Maria. I'm Bill Griffith here at CNBC Global headquarters today. We're looking at the pictures in the East Room of the White House, where the president is expected to begin that news conference at any moment. As soon as it gets underway, we will show it to you in its entirety. In the meantime, we will leave this picture up so we all can know exactly when the president enters the room, and at that point, we will cut away to it in full. But in the meantime, Maria, those markets it's been another comeback day here.
It really has been. I mean, we're off of the lows. We're still negative, of course, but the Dow is looking set to snap a 6-week winning streak. We've got the market down about 64 points on the Dow Jones Industrial Average. Ken Mahoney is with us from Mahoney Asset Management. Michael Gayed from ITAC Inflation Rotation Fund. Rich Peterson from S&P Capital IQ, and our own Rick Santelli. Rick, I want to kick this off with you. We had a weaker than expected auction yesterday. What set the tone today for fixed income?
You know, the fixed income market definitely found weaker demand for the three auctions totaling 72 billion, threes, tens, and 30s. But it really doesn't seem to have had a significant impact on the current structure. You know, we are slightly lower in yields, higher in price than we were yesterday, and the same could be true from a weekly perspective. I think the big story continues to be that the range is extended on interest rates and the curve is steeper, but it really hasn't gotten out of hand the last several weeks, as you can see on a 3-week chart. The big story continues to be the dollar index, and maybe specifically how the European currencies, the pound and the euro, are doing better, and the yen is. But the Japanese don't really want the yen to do better. They want to kickstart their export economy. So I think next week, from the U.S. standpoint, the inflation numbers and retail sales may give us a better indication of how the interest rates may refocus on the strength and or weakness of the U.S. economy.
Ken Mahoney, presumably one of the things the president will address during this news conference, certainly he'll be asked about it, is the terror alert that's been underway for all week, where they've closed many embassies and consulates around the country, around the world. But the markets haven't reacted the way they would in the past. You haven't seen this rush to safety in the bond market, to sell off stocks, things like that, although we have had a lower week. Why don't the markets react as much to terror alerts like they used to, do you think?
I don't know if we get more immune to it, but it seems, you know, this week's downdraft, we've been pretty resilient, holding on, as you mentioned. And I think the path of least resistance for stocks is to go higher. And I feel overall, because rates are low, it offers very little competition to stocks. And we're still in this kind of Goldilocks economy. I mean, not too hot, not too cold, maybe just about right. Not too hot to worry about inflation and the Fed raising rates and fighting that off, and not too cold for companies to operate in. And there's low rates is not just unique to the U.S. We see that around the world. Look what Bank of England said this week. They're going to target rates low as well. So easy monetary policy around the world, I think, trumps that at the moment, and therefore I think that bodes well for stocks.
Michael Gayed, you know, you have to believe with the market up 20% year to date that some people would view this as an opportunity to take some money off the table as we await this potential for tapering. What would you be doing? What are you advising clients here? Well,
or perhaps we see a different kind of great rotation out of U.S. stocks into that which is actually down this year, which is really the emerging markets and the cyclical reflation trade. Look at the way copper is behaving. Look at the way Brazil, in particular, among the BRICS, is starting to outperform. It looks like we may actually start to see a change in momentum. I've been calling emerging markets the next fat pitch in our mutual fund, in our separate accounts. We took a swing 2 weeks ago. Now it looks like, given that how much they are starting to outperform over the last few days, this could be the moment that a real move occurs to resync the global growth story to where developed markets are.
Is that what you want to do? You want to put money in emerging markets?
That's where we currently are right now.
Yeah.
Rich Peterson, if there's a bright spot, although it's not that bright for the president to point to during his news conference, would be the economy. Things are improving, and next week we get a slew of economic data to give us more pieces of this puzzle, don't we?
That's correct, Bill. As Rick Santelli mentioned, we got retail sales, some inflation numbers coming out, housing starts on Friday. But, you know, we go back to earnings, and the fact is, you know, when we started earnings seasons back on April 8th, we're looking for S&P 500 growth about under 3%. Now we're about 4.7. But really the underlying tally is excluding financials. Actually, we're seeing a deceleration in earnings growth without financials. From the fourth quarter, we were over 5%, first quarter over 3%. Now we're under 1% ex financials. So the concern is this is really a Fed-induced recovery.
We're waiting for the president. We've gotten the 2-minute warning, so once he comes out, we're going to take you there live. But in terms of this broader market, Ken Mahoney, let me ask you, in terms of putting money to work right here, would you do stocks?
Yeah, we have to be mindful. This was a 9-inning baseball game. Even though it's August 8th, we're probably somewhere in the 8th inning for this year's returns. And there's still some more upside. But again, if you get above 25% or so for the year for the Dow and S&P and the major averages, I would say you're probably in extra innings. So anywhere between now and 25%, I think you're okay. Anything above that, you probably want to rotate and take some profits. So I kind of think that's where we are right now at the moment.
Michael Gayed, what do you make of the rise in oil? It's been a very strong commodity this summer, and it continues higher. And how much of that do you think is what's going on in the Middle East right now?
It probably has something to do with it, but I would say it's about time. Oil has largely diverged, as well as other commodities, with the U.S. stock market and with Europe. So it seems like, again, part of this resync thesis that I have about the global reflation trade getting a bit back should include oil outpacing the U.S. stock market. Now, that, by the way, might actually cause a correction, while at the same time, emerging market stocks actually go up. This year, the two have diverged. Maybe they converge with the U.S. going down, emerging markets going up, commodities going up, to resync once again to this massive disconnect. I've made this point before. You know, emerging markets have lagged the S&P by the most since 1998. There's been no event. Rising oil should be a part of that.
Yeah, it's interesting that oil has been able to stay up here at 106 and not really create too much disruption for this market. Typically, when you have oil prices rising, Rich, that means it's sort of like a tax on consumer spending.
Yeah, that's going to sap the consumer purchasing power. But we're seeing some early signs of that. You know, we really had a great monetary stimulus, but really a fiscal drag, whether it's coming from the sequester or the fact that the payroll tax hike
Here
came
comes
about.
the president, Rich. Pardon me for interrupting. He's holding a press conference, and we want to listen in.
Everybody, please have a seat.